So is inflation really sticky, or is the report altered by unusually high reported rents? Joining us to debate and discuss, Aditya Bhave is head of U.S. economics at BofA Securities. Paul Christopher is head of global investment strategy at Wells Fargo Investment Institute. And CNBC senior economics reporter Steve Leisman is here with us as well. Steve, in the past 4.5 hours, have we learned anything about what's going on with owner's equivalent rent?
It just remains sticky, Kelly. We can't seem to get that series to match what we think is going on in the broader economy, which is a decline in rents and even home ownership, home prices. It remains to be seen what happens as the Fed reduces rates and mortgage rates come down, whether or not that brings more buyers into the market and perhaps pushes it up. But this series should have gone down, I don't know, 12, even 18 months ago relative to what's happening with other series. So I think the Fed will tend to discount this and maybe just see it as a snapback from some lower numbers that we had previously.
Well, that's exactly why I wonder if the Fed were to discount it, Steve, wouldn't that actually maybe take the impetus off of today's report, pushing them towards doing 25 instead of 50, for instance?
I think the report overall does sort of, as you said, nail in the coffin for 50. I don't think this is a report that says we have a real deflation problem that the Fed has to catch up to. I think the Fed wants to do 25. I think it will do 25. And I don't think there's much in today's CPI or tomorrow's PPI that would suggest the Fed would do 50. I would also note that the market increased the probability of a 25 basis point cut in September.
DL, bring you in here, and you are expecting, correct me if I'm wrong, 25s, maybe a series of them at the meetings to come. And how do you expect the Fed to talk about these rate cuts as well?
Right. So for now, we think the Fed is going to talk about the rate cuts as being somewhat gradual. I don't know they'll explicitly use that word because they don't want to pre-commit to a pace of cuts, especially when they know how quickly things can move around turning points. But at the same time, they do want to stress that the base case is for a soft landing, and a soft landing means that you cut relatively gradually to get back to neutral. So, they'll express some concerns around the labor market, as they should, but at the same time, they will express confidence that the economy is holding up. And so these are not rate cuts that are bringing you deep into accommodative territory. You're not yet saying, look, there's a recession, we need to accommodate the economy. What you're just saying is the time has come to get back to neutral, and we can do so fairly expeditiously, going 25 basis points per meeting.